Welcome back to the One-to-One Mining Investment Sydney, Day 2. We have a quiet but very knowledgeable audience this morning, so I expect a lot of questions from you guys. So joining me up here this morning to talk about Commodities Outlook, we have Matt Griffin, Co-Portfolio Manager for Australian Small Caps at Maple Brown Abbott, and David Franklyn, Co-Head of Funds Management at Argonaut. So thanks for joining me. And so, as I mentioned, feel free to put up your hand if you have any questions at any point. But to get started, let's talk about some of the macro impacts impacting the commodity space right now. So we have, China's economy not being as strong as expected, ongoing wars, inflation, interest rates. So how is all of this impacting the market?
Sure. Certainly a lot going on the macro side at the moment. As you mentioned, I think a couple of the key things we're looking at, firstly, supply chain's a big issue, and obviously the Western world's trying to reroute supply chains, become less reliant on China, and I think the long-term impacts of that really mean that you're going to have a more fragmented buy base for commodities. You're going to have potentially more inventory in the system. If you think about the whole goods chain, building that out across different countries, different continents, I think that could be quite positive for demand in the medium term. And the second thing we really are focused on is just the cost and hurdles to getting new mining projects up and running. We've seen CapEx and operating cost blowouts for most development projects in the last few years. Permitting is getting a lot harder, native title, so getting projects off the ground is becoming a lot more difficult. And I think what this means is longer term, we're going to see higher commodity prices because you just need those high prices to incentivise production to come on. I don't think a lot of the commodity analysts have really had a look at long-term prices yet. I think that's probably a theme for the next year or two when they sort of have to start looking at what prices needed to incentivise marginal production. And that, I think, is a lot higher than what people are assuming at the moment. So those are sort of the medium to long-term positives. Short-term is a bit harder to pick. There does seem to be a shortage of a lot of these commodities, but if the world does enter recession, demand sort of always outweighs supply in the short term. So 2024, if the world's tough, we might get another pullback in commodities, but I think medium to longer term, there's good reasons to be positive.
Look, I agree with a lot of what Matt just said. I think if you try and predict what's going to happen in the next 12 months, there's a lot of uncertainties. If you try and look out 5 years, I think you've got to be really bullish on where commodities are going. The way we kind of look at it is we kind of step back and say, what are the key resilient themes going to impact on the resource market? Things like energy transition is a theme which is really drives a new wave of demand for a relatively small group of commodities. Copper, nickel, lithium, rare earths, uranium, etc. So we think long term that looks good. I think the other key theme is just around geopolitical risk. And very clearly, we're entering an era of higher geopolitical risk, and we're seeing that obviously in Israel recently, Russia, Ukraine, tensions between China and the US, etc. So that's good for things like gold, but it also impacts on supply chains, as Matt was saying, and you're going to see countries reevaluate who they want to deal with. So who do they want to buy from, who do they want to sell to, and who do they want to partner with? And we think that's going to be a real theme going forward. So,
absolutely. I mean, looking at those kind of key resilient themes driving this demand in the market, what do you think are going to be, some of the, top commodities, or what's most of interest right now?
I'll kick off first and hand over to Matt. But look, the commodities we like are commodities like copper, nickel, lithium, rare earths, uranium are probably that basket. They're all going to have their ups and downs. There's going to be volatility year by year, and the outlooks can change somewhat. But it's hard to see that demand can't keep growing, and then the challenge is going to be supply keeping up. And I think the point Matt made before, when you look at consensus forecasts on those commodities, it doesn't really make sense. I mean, you guys being here today would have all seen the demand forecast for a lot of those commodities, and they're very bullish. And then you overlay that with commodity forecasts, and there's a mismatch. Either energy transition, for example, is not going to happen, or the commodity forecasts are way too low. And I think what's happening is people are looking at the short-term uncertainties and then rolling that out for longer periods of time. So I think the way we look at it is there's a good buying opportunity in those select group of commodities.
Yeah, I agree with a lot of the commodities you just outlined, David. Probably the two that are very interesting for us are uranium. We've sort of been on the uranium theme for a few years, maybe a little bit early, but that finally seems to be coming good in recent times, and I think there's still a lot of tailwinds there. Probably heading into 24 for that commodity, I think the supply side could disappoint. Existing producers, Cameco, Kazatomprom, are ramping up production, which has had risks. We've seen Cameco sort of miss production numbers already, and new restart projects coming back on, which again is a risk in this environment. So I think there's still legs to the uranium story. And the other one, which I think is not a bad bet at the moment, is gold. And, for many of the reasons we've just outlined, macro uncertainty, potential recession, gold certainly plays a good part in the portfolio.
Absolutely. So, you started to talk about kind of the shifting supply chains and how that's impacting supply coming out in the market. So, do you want to talk a little bit more about how you see kind of the development of these supply chains kind of in the medium to long term, kind of actually reshaping possibly the markets?
Sure. I think it's a very interesting topic because you're taking well-established supply chains in low-cost jurisdictions and you're sort of shaking that all up and saying Western governments now want to have their own supply chain, their own downstream back in country, and that's going to come with complexity, a lot of cost, and sort of higher operating costs because you've got high power costs, high labour in a lot of these markets. So I think that just leads to more inflation generally in the world. I think that leads to the need for high commodity prices. And I think it just means that governments actually become a greater part of the funding mix going forward, as we've seen in the past year. So things like the Inflation Reduction Act, NAIF funding, there's EU programs as well. A lot of these projects don't make sense economically just for regular debt and equity providers. You need that cheap government funding or grants to actually get these projects off the ground. So I think that's kind of how things are going to shift. There's going to be ups and downs. We've certainly seen with a lot of the downstream lithium plants, for example, in Australia that have started up, they've had issues ramping up. There's definitely seems to be a lack of technical knowledge in some of these new commodities, or just a lack of people who are in the industry who have that expertise, given how rapidly things are developing. But look, I think overall, I just come back to the point, it's just going to lead to more and more inflation. I think that's going to be the theme for the next decade.
Yeah, I think the whole supply chain issue is really fascinating. And the way I kind of look at it is if you think about how democracies work, when things are just bumbling along as typically they do, there's not a lot of incentive to make major change. And I think what's happening now, when there's a lot of tensions emerging, you stand back and you look at where are the raw materials being produced and where are they being processed. And the alarming thing is in general, across most of the key commodities we've talked about, they're in locations you don't really want to be or you don't want to be reliant on. And that's because countries like China, for example, will take a longer term view. And so that's why the US and the UK and the EU and Australia are all standing back going, hey, this doesn't look too good. We need to start doing things differently. We need to start building our own processing capability. We need to incentivise production in our own country. So I think we're starting from a long way behind, but I think it's going to take place, and there's certainly commitment there, and that's got to be driven by governments as much as anything else. And I think we're seeing that now, so I think that's positive. Lithium's a good example. What the world's been able to achieve in the last 5 years has been pretty good, both on production, where Australia now produces roughly 50% of global lithium, and you're also seeing a development of a processing sector outside China, which I think is also critical.
Do you see kind of governments really pushing for that full value chain within the country? Like, so say, take for instance Australia, which doesn't necessarily, it has the resources, but it doesn't have the other kind of side of things. Do you see a lot of push for that?
Yeah. I think so. I don't think it necessarily needs to be in the same country, but it needs to be within the same same group of countries that that have worked out, these are people we want to deal with. I think lithium is a really good example at the moment, because what you've seen is you've seen some early movers on the processing side, and it's proven to be pretty difficult to get production up to nameplate. And I think a lot of the newer scale producers are now standing back and saying, should we be producing hydroxide, or should we be producing an intermediate product? So I think there's still work to be done on how this is implemented, but I think we'll get there.
Yeah, it's a good point, actually. It doesn't necessarily all have to be in the same country. It's just the same group of kind of friendly nations. But I think what a lot of these governments are realising is it's very easy to make policy, but actually very hard to put into action. So if we have a look at, the first cut of the Inflation Reduction Act, everything was meant to be in the US or countries with free trade agreements. And then they've had to go through, well, what happens if it's a Chinese company that owns a battery plant in the US? How is that going to be treated? Or what happens to material from neutral countries that aren't necessarily part of a free trade agreement? So we're having to work through these exemptions, and I think it's going to prove a lot more difficult than people think, just to put a policy on paper and execute it without thinking about how the supply chains work at the moment and how much work's involved in moving that around.
Mm-hmm. Absolutely. Do we have any questions from the audience? Oh, we've got a few. All right, we'll just get a microphone over to you.
Just wondering on your views on US interest rates in in 2024 and how that might affect commodity prices.
Yeah, it's a good question. I'm an optimist at heart, but you say US interest rates going from 0 to 5%. Soft landing, everything's going to be okay, is probably a bit of a stretch, right? So you'd have to say, moving to 24, the chances of those interest rates biting and having a big impact on global economy, you have to factor that in. So as we alluded to before, I think the outlook in the next 12 months is potentially, it's difficult to predict, but it could weaken reasonably significantly. So the view we take is twofold. One is look for commodities that perhaps aren't as economically sensitive. I think uranium is a good bet. I think rare earths, is also kind of interesting. But, commodities like copper and nickel, zinc, potentially lithium, you got to be cautious there. So I think the opportunity is to target the good quality, good value copper producers and developers, because they could come under pressure in the next year, and that's probably a buying opportunity given medium to long term we see commodity prices, in those commodities probably undervalued and going significantly higher. So that's kind of the way we're looking at it. Be cautious on the economically sensitive commodities, seeing as a buying opportunity, but on the back foot. But switch the portfolio to orientate towards those commodities that aren't so leveraged to short-term economic growth.
Yeah, I've got a pretty similar view to David. I think it's kind of interesting, interest rates going from 0 to 5, the macro environment's been remarkably resilient in the face of that. And I think that's because employment's held up so well. I saw a chart yesterday that shows that basically unemployment initial claims really start to skyrocket about 18 months after you see that initial yield curve inversion. So that potentially is pointing to March next year as the point where we start to see unemployment rise. And to me, that's what I'm watching. I'm watching the employment rate to see as a barometer for the macro. Interestingly as well, given how weak China property especially has been over the past year, I've been kind of surprised how well iron ore, copper, those sort of commodities have held up. And that potentially is a bullish sign. Historically, if you'd seen that weakness in data out of China, those commodities would have traded well into the cost curve. You're still at a point today where pretty much everyone's making money. So that maybe comes back to this whole rerouting supply chain, the medium-term deficits people are seeing or predicting, and potentially there's buys there just with a view to maybe the medium term or hedging out some of that risk.
Just adding to that, I think China is really the big unknown as far as commodities and what might happen in the next 12 months. So, the positive spin on what could happen next year is you get China coming out with a big stimulus, and you get the economy slowing pretty rapidly to the extent where the US says, comes out and says interest rates aren't going any higher, and in fact, at some point in the future, we're going to start reducing. And it could be off to the races again, right? So it's very uncertain, I think, on how it could go in the next 12 months.
We have another.
Yeah, David, just on the energy and the U308, what is going to be the forward policy here? Everyone talks about it, but to get these plants up and going is a long-term project, up to 7 to 10 years. How are we going to cope with that time frame, given the global warming, given the other options we've got, given green energy, when all these things take longer than people think and they cost more and they need green commodities? Can you comment on that side of it?
Yeah, look, I think uranium is part of the mix. It's not the total mix. It's not the total solution. So I think what I'm encouraged by is the attitude towards uranium is changing. But as you're pointing out, that is the first step into actually, lifting production. I think in the short term, what you're going to see is a lot of the projects that have been mothballed, care and maintenance, that kind of stuff, will come back on. There's a couple of advanced projects, for example, NextGen in Canada, which I think will progress. So you will see, lift in production, and I think you'll see that industry kicking off. I think, Australia is still, way back in the field, and I think that's going to take some time for projects there to kick off. But Matt, don't know if you got any thoughts on that.
I'd just say I think the positive on the demand side of uranium over the past couple of years has just been the changing attitude from Western nations towards nuclear power. So a lot of Europe and US states were going to phase out nuclear. A lot of them have 40, 50-year-old reactors which were due to be shut down over the next few years, and that attitude's changed. We're now seeing reactor lives extended. So I don't think we're going to see many new reactors in the Western world. It's pretty difficult for a politician in a 4-year election cycle to say, well, I'm going to spend $10 billion on a reactor and it'll be done in 7 years. It's a lot easier in emerging markets like China and India where they can take a 10-year view. But I think just the lack of those existing plants turning off, potentially some new technology around small reactors and what that means. But for us, uranium is really a supply story. There's just been a lack of supply, and I think inventories are starting to run down. We're starting to see recontracting come through. I think that's the first leg, and then maybe we start to think about demand in a few years' time when the industry sort of normalised.
Just on the point of David saying about democracies, I mean, the main objective of the government is the care and feeding of the incumbent party, including our friends who sometimes their judgment is overridden by their ambition. But just on the mergers and acquisition on the lithium, I mean, just given what's been happening with Liongate, what's going to happen in the pricing of lithium, do you think, given all this corporate activity? What do you think?
Yeah, it's a big question. I mean, I think what you're seeing in lithium is really a new industry that's emerging before our eyes, right? Which you don't often see. So it's gone from minuscule, and in 10 years' time, it'll be a decent-sized bulk commodity kind of market. So that's why you've seen the price volatility. In the early years, it was very depressed, and then demand exceeded supply, and price has gone through the roof, and now you're seeing some kind of stability. If you go back to 2021, I think spodumene was around $400 or $500 a tonne, and it got up to $8,000 a tonne. It's now back at say 2.5 to 3. If you could sustain a price around 2.5 to 3 long term, the industry is going to be very profitable. If you look at Pilbara's last result, the financial year 23, their EBITDA margins were over 80%. Now that's not normal, right? So, and the question with Pilbara is that as good as ever going to get. So I think you're going to see just a maturity of the lithium market. I think it's going to settle probably somewhere between $1,500 and this is spodumene I'm talking, between $1,500 and $3,000 per tonne over the in US dollar terms over the medium term is the way I'd see it. But good growth. I think you're going to have spikes on the upside and on the downside. The market's still going to pretty much triple in the next 10 years, probably more than that. So I think there's good growth in demand, and the question will be how quickly supply can come on. But it's an emerging industry.
I'll add a couple of things to that. Lithium is quite interesting because it's a very long supply chain. There's a lot of steps between mining spodumene, converting, going to the battery packs, and ending up in the car, and that process takes months. So when you see weak periods like we are with China vehicle demand at the moment, that really causes destocking at every level of the supply chain and takes quite a while to flow through to spodumene prices. So And you know, it's the reverse as well. We saw early in the year the reverse happen and prices sort of ramped up over a period of 4 to 6 months. That's because it's an early industry and no one's really set those up properly yet. The other thing with lithium is, you know, long term, everyone's clustered around a $1,500 per tonne spodumene price, but everyone's expecting long-term deficits, and it's kind of hard to marry those up. I think what we haven't really settled on yet is a lot of questions around the battery. So what's the optimal battery going to be? Is it LFP or NCM or something else? What's the size of the battery pack going to do over time? You know, I'm probably a believer that as we progress into owning electric vehicles, people have less range anxiety. Charging infrastructure gets built out. Potentially you can have smaller battery packs and use less lithium. And then there's technology as well. So sodium-ion batteries, which look like they might take a big chunk of the storage market. And, you know, small changes in those assumptions really have huge impacts on your supply-demand 10 years out. And because we're so early in the piece, it's very hard to figure that out yet. So my view is short-term, hard to tell. That's based on macro and what happens in the world. Car demand is very linked to global growth. I think over the 3 to 5 year period, it should be a very positive period for lithium. I think people are underestimating how difficult it is to bring new mines on. And just you've seen pretty much every lithium developer has had problems ramping up, especially on recoveries. And then long term, again, there's a huge range there, I think, depending on a lot of those assumptions around battery chemistry and battery size and that sort of thing. So it's, yeah, interestingly enough, I've probably got a lot more conviction on the 3 to 5 year story than the 1 year story or the 10 year story.
I mean, do you want to go a little bit more into kind of that technology risk and how kind of different battery chemistries might impact the different kind of battery metals supply, demand, pricing?
Yeah, I think history would suggest that changing in technologies often comes faster than people are expecting. And, you know, you even think back a couple of years where the big question mark was, well, how are we going to meet supply of cobalt and nickel? And, you know, nickel in particular, the last couple of years, the supply outlook has changed dramatically. So you could say, and I think if you look at lithium, something like direct lithium extraction could have a big impact on how quickly some resources can get to market. So I think often you can't predict it, but I think you've got to be aware that things can change. And then, as Matt was saying, on the actual commodity mix in the batteries, that can also change. So I think you just got to be aware of that and watch it.
Yeah, it's funny, you know, like every time you see a supply-demand chart out 10 years, it's always a deficit. I've never seen one that's a surplus, and it never seems to happen. The nickel and cobalt analogy is a great one from a few years ago. You can probably look back a decade and people were saying there's going to be a big shortage of platinum, palladium, those sort of metals, and that's completely gone away because those metals aren't needed in electric vehicles. So things do change. Technology comes along very quickly. The demand side also changes if prices are high for a long time. You get thrifting, you get substitution, you get different technologies coming through. So that's potentially a caution on these huge deficits in lithium and other battery metals that people are projecting out for the next decade.
We have another question.
On that pricing with the lithium, the way the nickel's been moving, something very dear to our hearts because they're such a versatile metal. How do you see that pricing given from where it is now going forward? Have you got any ideas on that pricing?
I think the short answer is it's going to be lower than where we might have thought 12 months ago or 24 months ago. There's a huge supply coming out of Indonesia, which you're probably aware of, and I think that's the question mark. The impact is the question is how that impacts on the market, because there's obviously ESG implications from the laterite production versus the sulfide production, and whether there'll be a price differential between the two to reflect that ESG sort of supply chain. But you'd have to say the overarching outlook is worse because I think the price will be lower than it otherwise would because supply and demand. I think there will be a price premium for nickel sulfide projects, and I think a lot of the auto manufacturers will want to be able to demonstrate that they're sourcing reliably and ethically. But they're going to be the price is going to be lower than where it was before. So I think the outlook for nickel is certainly deteriorated.
Just on the cobalt, which is very exciting, it actually comes from, I believe, a German word, Cobalt, which is the fumes that exuded from various metals in the Congo from the Germans and Belgians, and that's why they called it this fumes. But just given that the Congo GRC produces 60% of the world's cobalt, what is your view, particularly your funds management view, on geopolitical risk there? Have you got any experience with DRC?
I reckon. I think the DRC is almost uninvestable, and I think cobalt, it's very difficult to find pure exposure. Typically, when we're building our portfolio, ideally we're trying to find companies that have a pure exposure to a commodity, or at least the vast majority of their earnings coming from a single commodity, so we can sort of balance the portfolio that way. The issue with cobalt is often it's co-produced with other commodities, and so you can't get that. So when I look across, for example, the ASX and say, how best do I get cobalt exposure, there's no good way. So we tend to stand back. As far as building our portfolio, we're very cautious about where the underlying projects are. I guess our view is if you get the commodity price call right, you don't need to necessarily go to high-risk locations. And in fact, that can work against you, because you can make a good call on nickel or copper, and then you're in a project in Africa or South America, and due to the geopolitical risk there, it impacts on your ability to make money. So we're pretty cautious about going into those kind of locations. Yeah.
I mean, I thought we could look back. You mentioned the ESG implications of things like Indonesian nickel. How much does that impact investment into projects, or kind of how much is that impacting where decisions are made?
Yeah, I think it's making a huge impact. And I mean, you've just got to look at the withdrawal of banks from lending to fossil fuel projects as an example. And I mean, if you're starting up a coal and oil project, you're going to have to go to alternative funders rather than banks, because the ESG pressures are just there, and it means that money's not available. So you're seeing increased risk premiums in those sort of projects. There's potentially lower cost money going towards battery materials projects as well. I think, potentially there's a risk for something like the gold sector, where you say that is responsible for 0.5% of global emissions, which is actually quite a large number for just the gold sector. And if ESG investors and governments start to look at that sector and say, well, why are we digging up a shiny yellow metal with limited use for all these emissions? What's the purpose there? So again, I think this just makes it harder for investment in a lot of sectors, and it does shift where a lot of funds will invest. We don't run an ethical fund. We do consider ESG as part of it, and it's a trade-off for us. The worse the ESG credentials of the commodity and the company, the higher risk premium we put and the higher return we need to see out of a stock. The other thing I think we're going to see on the ESG front is maybe just a changing of the narrative around decarbonisation. Over the past couple of years, a lot of companies and miners have put out net zero targets by 2030, 2040, 2050, and I think there's not a lot of work that's gone into how that's going to happen, and we're already starting to see some companies that are walking away or pushing back on those targets. So I think that's going to be a theme over the next 2 or 3 years, is how are those decarbonisation targets actually achievable? Can they happen, and what does that mean, and how does that really change the way investors see companies?
Yeah, I think you're right. I think ESG, love it or hate it, it's here, and it's a major factor. And even at the sort of grassroots of mining, I think you're seeing a trend towards underground mining versus open pit mining, for example, because of the reduction in disruption. So I think it's there, and increasingly I think the market will value companies that make more of an effort. If you look at the gold sector, and I think Matt's made a very good point about what's it good for, and we will have that discussion later, I think. But if you look at something like Bellevue, which is sort of an emerging miner coming on, which has adopted a very sort of ESG focus, the market's rewarding that. So I think companies will see that, and they'll pick up on that, and they'll continue forward.
We have another question.
I know your discussion is regarding metal supply and demand. But given the fact that we're seeing literally hundreds of juniors lists in the TSX and other places, and we've all seen there's obviously not everyone can be successful. There's a lot of downward pressure on many of the the early stage exploration projects at the moment. Can you discern anything from your own investor flows as to what people are looking for in the future? I mean, I must say the question's somewhat without notice and maybe not too related to your topic, but if you wouldn't mind just commenting on what you're seeing from your own investors.
I've probably got a very different answer than David because we run a generalist fund. So resources is 20 or 30% of our portfolio and the index and the rest is industrial. So really what we're doing is just a general small cap fund and our investors are looking for capital growth. Not too interested in dividends or larger cap sort of stable companies. They want companies that can grow. And that's becoming a challenge in the resources sector. If you look at a lot of the small and medium cap companies, there's not a growth outlook. A lot of the WA gold producers have pretty tight assets, just running hard to maintain production. I think probably what we'll see is more M&A, as you rightly say, the juniors are struggling for funding. A lot of them have good ground, good projects, but just can't go the next step. I think one of the themes for the next couple of years will be more M&A just to build out that growth profile, because there's a lot of generalist investors like me who come and go from the resources sector, and generally the less knowledge you have on the space, you want to get into gold, you're going to look for who's got a growth profile, who can show growing earnings, rather than trying to figure out valuation for a declining asset or a short mine life asset. I don't think a lot of the producers have sort of cottoned on to that yet. There's just a huge amount of generalist and index money coming in, and big generalisation is that the bigger you get and the higher growth you show the market, the more of a re-rate you'll achieve. And I think M&A is a good way to do that in the short term. There's obviously a lot of risks around putting management teams and projects together in the longer term, but I think that's probably a trend we'll start to see a bit more of.
Yeah, what I would add is I think the big difference is it's difficult to raise money in resources in general, and the big change I think between now and previous mining booms is the role that Canada's played, and their capital markets have really moved away from resources. So Australia is really a dominant player in resource funding. So I think that's the first point. The second point is what we're seeing is, as you're saying, there's a whole lot of early stage and relatively early stage mining companies, and only a limited pool of capital that can be allocated to those. So it's really a matter. The way we look at it is it really needs to be a special kind of asset. It either needs to be global scale, or it needs to be a logical bolt-on or addition to an existing player looking to provide growth. Outside that, it's kind of difficult to get excited. So we're a specialist natural resources fund, and we can invest from the smallest company to the biggest. But 70% of our portfolio would be in companies with a market cap above $1 billion, because liquidity is important. The problem, as retail investors would well know, once you invest in these small companies, and the market or the commodity price turns against you, often you become a long-term holder even if you didn't expect you were going to be, because liquidity dries up. So liquidity is a big factor in the market as well. I think the final point I'd make is the fact that Matt's here today is really good, because I think the big emergence will be when you look at growth in the market and companies that can provide growth, and looking for resilient themes that are going to be positive going forward. Resources does have potential because of the energy transition. So I think what you're going to see is a lot of generalist funds, small companies funds, increase the proportion of their investment into the resource sector, which I think is really good. But they're going to do it in a risk-controlled way. It's not going to be at the really grassroots level. It's going to be the advanced developer and the producer, which I think is a positive.
I think the other interesting change we've noticed in the last few years from a client base, and particularly the institutional client base, 4 or 5 years ago, super funds and instos were saying to us, you need to start thinking about divesting coal and divesting oil. We don't want any of these carbon emission stocks in the fund. that narrative's really changed over the last few years with just a spike in prices in those commodities and energy security concerns. The conversation now, and has been for the last couple of years, very much around engage with those companies. We don't want you to sell them. We want you to engage and try and improve ESG practices. But basically, I think those investors just don't want to miss out on the returns that they've seen. They don't want us limiting the fund in that way. And they'd rather see us as not necessarily an activist investor, but just a bit more engaged with how we improve practices rather than saying just divest or you can't invest in that sector.
We have another question.
69% of the energy source in this country is fossil fuel. How do you see that percentage looking in 7 years' time?
Good question. Look, it's going to decrease. It just depends to what extent. If you look at the power generators, a lot of them have put end dates on their coal plants in the next few years. I think we're already starting to see maybe a few of those need to be extended because the transition to solar and wind just isn't there yet. There's a huge amount of investment going on in solar and wind. The government's backing a lot of these projects. There's renewable energy zones set up where there's special tax arrangement and that sort of thing. So the returns are there, the funds are there to actually invest in these renewable projects. I think what's really lagging is the grid infrastructure and just what happens, when the sun's not shining and the wind doesn't blow. I don't think the storage or the grid is in place yet, and I don't think that will be for some time. So it wouldn't surprise me to see that percentage of fossil fuel and coal generation and gas potentially remain a higher part of the mix than what people expect over the next 7 years.
Yeah, and
Yeah, go on.
yeah, sorry, I agree. I mean, I think energy transition is a transition, and I think what you've seen really over the last couple of years is if you start to change supply before demand has changed, then you get price spikes, and that has a negative impact on on cost of power. So I think you're going to see the trend continue, but perhaps slower than what people had expected. I think clearly thermal coal is under the most pressure. I think gas is increasingly seen as a transition fuel. Renewables probably need more of an emphasis on battery storage to kind of support that and help it being a true baseload provider.
Just on that, the time given 7 years out, how are we going to produce all this green material, such as we've discussed today, to make all this material like the sun and the wind? What's the forecast on those commodities to be able to achieve those objectives?
Well, I think it's a good point, and to me, if you look at what's driven the demand for a lot of the commodities that we've talked about today, copper, nickel, lithium, rare earths, etc., it's actually around the transport sector. It's around electrifying a whole lot of industries, but it's not really been addressing grid power and the move away from fossil fuels. And I think that's really going to be, if you ask me what's going to be a shift over the next 5 years, I think that's where it needs to be. It needs to be going, do we need to be promoting uranium as nuclear power, as we've talked about? What can we do on battery storage to support the renewables production? I think you are seeing a rapid build out of renewables projects, which is positive. But then how do you integrate that into the grid system? So I think it's just it's a process that's taking time, and I think that the commitment's there, but as you're saying, it's a longer, harder road.
We're a bit short term here on everything we do in a lot of ways. You would know as fund managers versus some of the institutions in the UK that take a much longer view. And of course, China, we know the story there. It's always long term.
Yeah, absolutely. As a fund manager, really, you try and deliver returns, and you got to deal with the market that's in front of you and look for where the opportunities are.
I mean, I'm just noting the time on the clock, which we're almost out of time. But I thought, there's been a lot of kind of key themes that we've been talking about today. So, energy security, grid storage, ESG, supply chains. What do you think is kind of going to be the key just to summarize, I suppose, key drivers for the industry for the coming short to medium term?
I really think, if we look at a few of the topics we've talked about today, I think short term, it's just what the macro environment looks like in 24. Do we have a global recession? How bad is that? I think that's far and away the biggest short-term driver, regardless of what you think about medium term around commodity supply and demand. I don't see any of the tailwinds behind decarbonisation going away anytime soon. So medium term, copper, lithium, nickel, those sort of commodities will still be very much in demand. And the supply side is just getting harder every day, it seems. So permitting risk, funding, I just think that keeps pushing projects out and leads to supply shortfall. So near term, hard to tell. Medium term, I'm fairly bullish.
Yeah, I agree with everything Matt's saying. I think there's uncertainty in the short term. Long term looks really good. But if there's a thematic, it's the one that I just said. I think a lot of the focus has been on batteries going into vehicles, and it's really sort of captured the public's attention. But I think fundamentally what needs to be addressed is grid power and how we move that away from fossil fuels to alternatives. And it's not a quick fix. But I think it's one that needs to happen. And I think you're going to see gas come back as a transition fuel. I think thermal coal will continue to fall as far as a percentage of market share. I think nuclear power will become more of a discussion. And I think battery technology, stationary battery technology to support renewables will be a major focus as well.
All right. Well, that's a perfect time to wrap things up. We've just gone into the red on our clock. So I want to thank our panelists for joining us up here this morning, as well as the audience for all of your great questions. So thanks.